Watch this candle. Price jumps 3% in a single session. On the surface, that's a breakout, the kind of move that gets retail traders piling in. But look underneath it, at the volume bar. It's thin, below average. Barely anyone showed up to this rally. A big price move on very little effort. To a trained eye, that's not good news. It's a red flag. There's a 100-year-old discipline built entirely around spotting mismatches like this one. It's called volume price analysis, and it makes a bold claim. Volume is the one thing that biggest players in any market can never fully hide. Long before screens, there was the ticker tape, a thin paper strip clattering out of a machine, printing two numbers over and over, price and shares traded. That's all Charles Dow had. He noticed volume tended to confirm a trend. Heavy volume meant a move was real, light move, volume meant treat it with suspicion. Decades later, Richard Wyckoff turned that hunch into a system, taught as a correspondence course, and distilled it into 3 laws he claimed quietly govern every market on earth. Jesse Livermore and Richard May traded on the same logic, reading the tape like a lie detector. Fast forward to 2013. A British trader named Anna Coulling, who says she got tired of being talked down by financial advisors who assumed she couldn't handle the math, decided to teach herself the market from scratch. The result was a book, a complete guide to volume price analysis. Its tagline says it all: read the book, then read the market. Coulling's whole method rests on 3 Wyckoff laws. First, supply and demand, the oldest rule in economics. But when buyers outnumber sellers, price rises. Simple. But the other 2 laws are where it gets interesting. Second, effort versus result. Volume is the effort. The price move is the result. In a healthy market, they move in proportion. Big volume, big move. Where they don't match, something's wrong. That fake breakout from the very start of this video, big result, tiny effort. A classic trap. Professionals testing the market before reversing it. Third, cause and effect. Before any real trend, there's a quiet build-up. Weeks of sideways, boring price action while volume slowly changes hands. Wyckoff called this the cause. The bigger that base, the bigger the eventual move. It's a spring being compressed before it's released. Put it together and Coulling paints professional money as a kind of retail store. Buying inventory cheap and quiet during accumulation, then marking it up and selling it to an eager public during distribution. The volume bars are the receipts, the one part of the transaction that store can't erase. None of this is new. It's 100 years old, but Coulling's argument is that it still works because markets are still driven by the same 2 emotions, fear and greed. Algorithms have replaced the ticker tape. Dark pools have replaced the trading floor. But somebody, somewhere, still has to buy before they can sell, and that leaves a footprint in the volume. It isn't foolproof. In spot forex, there's no central exchange, so there's no true volume at all, just an estimate, and volume without context can mislead just as easily as it can reveal. Coulling is clear about that. The method is a lens, not a crystal ball. So the next time a chart makes a huge move, look past the price. Look at what's underneath it. Somebody bought, somebody sold. And volume is the number 1 in the whole system that never lies to you, even when everything else.